Okay, so we're back in action with Microsoft, and we're interested in looking at how the DOJ should try to prove that Microsoft has an operating system monopoly. Clearly, market share is one way, and another interesting way is ROE. So let's start now by looking at Microsoft's, at the time, most recently reported annual financial statements, starting with their balance sheet up here. So they have a cool 23 and change billion in cash, which is about a third of their total assets. They have total liabilities of about 32 billion, equity of about 31 billion, and that's about it for the balance sheet. Pretty amazing balance sheet. A lot of cash on that balance sheet. And just FYI, for comparison, Apple, as of the end of the year 2012, had $40 billion in cash and short-term investments. That was about 20% of their total assets, and that huge amount of cash precipitated a suit by David Einhorn of Greenlight Capital to get Apple to start dividending out some of that cash to owners of the firm and or buying back shares. Okay, so back to Microsoft. So in the latest year, at the time reported, they had revenue of a cool 60 billion, operating expenses of about 38 billion, so giving them operating income of 22 billion. Interest income, right? That big pile of cash they have is generating interest, right? And they don't have any interest-bearing liabilities, so their net interest is going to be income, not expense here. So about 1.6 billion. They pay some income tax, a lot of income tax, about a third of their revenue. Sorry, that's their income before tax is 23. So they're paying tax of 6 billion, about a tenth of their total revenue, and their net income is almost 18 billion on 60 billion of revenue, which is pretty amazing. So now here's an interesting thing to do with Microsoft. It's to look at the company as actually two firms. So here, this first column represents in both Microsoft's balance sheet and income statement how the firm represents itself publicly, okay? And the DOJ's idea, and it's not just the DOJ, any good analyst on Wall Street would want to do this as well, is to look at the firm as really two separate entities, one being a cash manager, right? They have that huge amount of cash to manage, okay? And the other being the operating entity, right? Which is going to be considered the monopolist by the DOJ. So I'm just going to put in operating entity here. Entity, all right. So that's their primary operating stuff. The cash manager is sort of a secondary business that they have. So let's look at how we could do this. If we were Microsoft, we could spin off to the owners of the firm the cash management business, create a completely separate company, and everyone who owned Microsoft shares would be given proportionally shares in this new spin-off company, Microsoft Cash Management or something like that. So they could spin it out with, of their 23 billion in cash, about 20 billion, and leave around 3 billion for the operating entity. The cash manager would have essentially no other assets, certainly not measured in billions, no liabilities in Microsoft, so there'd be no need to spin out the cash manager, certainly, with any no interest-bearing liabilities, so they're not going to spin out the cash manager with any liabilities. And if we pull this through, we have the total equity here of 20 billion for the cash manager. Again, no liabilities. And we have 10 billion and change still total equity for the monopolist. Okay, so why might we want to do this? Well, let's keep going and figure this out. So if you are the cash manager on your 20 billion, you're going to earn interest of about 1.6 billion, and this is really nice work if you can get it, because all you're doing is investing this money in treasuries and other very safe instruments. And let's say it takes about $4 million to manage that money. You could do it actually for much less than $4 million. So you have operating income of still about 1.6 billion. The amount it takes to manage this money is almost negligible. And we pay some tax, and then we get down to net income of $1 billion on the 20 billion in cash that we're managing. And the operating company is still going to have 60 billion in revenue from operations. It's going to have essentially the same operating expenses. So it'll have similar operating income. It still has no interest-bearing liabilities, so it's going to be paying no interest. And now that it only has 3 billion in cash, the interest it gets on that is going to be a very small number, so I've just left that as 0. And we've got them paying some tax at the same rate as previously. And the net income is about almost 17 billion. Okay, so now here's the interesting thing. As Microsoft represents itself publicly, it has this very high cash level, higher than any other wildly successful technology company at the time by a large amount. And it's got a pretty scandalously high ROE. If we just look back a couple of pages, firms that were doing extremely well at the time, Oracle, Cisco, ROEs not getting north of 25%. So Microsoft's ROE is more than double that if we just go with the way they're representing themselves publicly. But if we look at the firm split up into two different entities, we see the cash management firm has a nice conservative ROE of 5.2%, but now look at the ROE of the operating entity. That's really, really quite incredible, 155%. If we reduce their cash level down to a more reasonable amount of 5% of annual sales. And essentially, there's only one way to get an ROE like this, and that's to be a monopolist. And the reason for that is that any competitors, potential competitors you may have, are going to see this ROE and say, my God, this is on the order of 6 times more than the best companies in other technology business. So let's compete with Microsoft, do what they're doing, and share some of this awesomely fantastic ROE. That can't happen if Microsoft is a monopolist. So that's the argument, is that the extraordinarily high ROE, much higher than wildly successful technology firms working in areas where there is no monopolist. You look at this ROE and you say this is only possible for a monopolist firm. And you could even make that argument here, but the other point I want to make is that this cash management part of the firm degrades and masks the incredible ROE of the monopolist, because this guy, our 57% ROE, is a weighted average of the cash management firm and the operating business. Okay, so you can, if you are a wildly successful firm, you can make yourself look not as good to the government, to the IRS for tax purposes by having a big cash management business. Okay, so what happened in the lawsuit? So Microsoft was found to be an antitrust violator for reasons of market share and its egregious, I wouldn't say egregious, but incredible ROE. It was decreed that Microsoft had to allow PC makers to omit the Windows browser, Internet Explorer, from the operating system. So Microsoft, not being dumb, they said, okay, that's fine, but we will give it away for free to anyone who wants it. And even though Netscape had a better browser, most people said, you know, I can get something that works. Maybe it's not the best thing for free, or I can pay $25, which was about the price at the time, for Netscape, and which is better, but it costs $25, so I'm going to take the free thing. So they Microsoft drove Netscape, headed by Mark Andreessen, out of business. Okay, so now let's jump on to our last two ratio analysis methods. The first is going to be financial and operating leverage, and I just need to double check that we are recording here just fine. We are. Okay. First, as usual, let's think about what we mean by these terms. Financial leverage is defined to be some kind of debt financing over some kind of equity financing, or some kind of debt financing over a firm's total financing, or debt divided by some measure of income or cash flow. And when we use this, the units of this are going to be years, because we have cash in the numerator, cash per year in the denominator. You sort all that out and your units are years. Your net units are years. Operating leverage is a measure of fixed costs to variable costs. We looked at fixed costs and variable costs a little bit already with the SGA margin ratio and the COGS margin ratio, respectively. And now we're going to define these two terms a little bit more carefully. Fixed costs for us are going to be costs that do not scale with small and medium increases in sales, and variable costs are going to be costs that do scale linearly with small and medium increases in sales. Okay. A key property of both financial and operating leverage is, in both cases, increased leverage is going to mean that we get increased returns to owners when sales are big and growing, and an increased probability of bankruptcy when sales are low and slowing. Okay. Leverage ratios are therefore aiming to measure upside to owners in good times, and also at the same time risk of bankruptcy in bad times. All right, so let's start with financial leverage ratios. Financial leverage ratios are most commonly used by analysts and others outside the company. And so I'm going to say, so it's outside the company. And the reason why is that the data that we need for financial leverage ratios comes directly from the financial statements. And for the operating leverage ratios, it's going to be harder to get the data that we need. All right, so our first financial leverage ratio, debt to assets ratio, is going to be total debt of a firm, and this is important that long-term debt, short-term debt doesn't matter, okay? Total debt of the firm divided by total assets. So what's it telling us? So given that a firm has a big pile of assets, this ratio is telling us what percentage of those assets book value was financed by debt. So that's a helpful thing to know, because the more that's financed by debt, the better the company, the shareholders are going to do in good times, but the more downside risk they have. Okay. And it's interesting to note here that for a regulated utility, it can have a very large debt to assets ratio, right? So its shareholders can expect to do really well in good times, more risk of bankruptcy in bad times, but that ratio can get really big because for a regulated utility, the risk of bankruptcy is very low. Usually regulated utilities are regulated monopolies. So they have a guaranteed base of business. Pretty hard to go bankrupt in that case. For a technology startup, you always want to have a very low debt to assets ratio, because if you lose one big customer, one big product launch goes bad, your revenue could drop by 50% for 6 months, a year, overnight. Okay, and if you've got a lot of interest payments to make, that could force you easily into bankruptcy. So you want to avoid that. Okay, now let's think about for a second why financial leverage matters. And what I'd like to do here is imagine that half of the class is comprised of conservative investors and half of the class is comprised of cowboy investors, okay? And each of these groups just gets magically $100 million to invest. And what each of these groups has decided is that there is a great firm they're interested in buying, okay, that has a balance sheet that looks like this, okay? It has $100 million in assets and no debt and $100 million in equity, okay? And the conservatives are going to go ahead and buy this firm using the $100 million that just dropped into their lap. They're going to buy all the equity, all the outstanding shares for $100 million, and they're going to own 100% of the assets. What the cowboys are going to do is something quite different. They're going to take 10 million of the 100 million that they just received, and they're going to purchase 10 million worth of the shares of this company. Then they're going to go to Jamie Dimon at JP Morgan Chase, and they're going to say, hey, we have this great company we want to buy, and we need some help. Why don't you give us a loan of $90 million to help us buy this company? And they talk Jamie Dimon into this. So what do? They get $90 million from Jamie Dimon to pay off the previous owners 90% of the ownership. They have 10 million of their own money that they're going to use to pay off the other 10% of the ownership. But now look at the structure of the firm. The Cowboys own the whole firm, but there's only 10 million now in equity outstanding. The rest is in a loan, okay? The conservatives own 100% of the firm, and there's 100 million outstanding because they have no debt. So very different financing structure. What the Cowboys did to affect this financial structure is what's called a leveraged buyout. They buy the firm for 100 million, but where they get the money for that, 90 million came from a loan that the company is going to have to pay off, and 10 million came from the private equity firm's own funds. So this would be something that a private equity firm does. Okay, so the debt they negotiated with JP Morgan Chase is a revolving loan with 10% interest. Revolving loan just means that there is no formal maturity date, or if there is, it's very far into the future. So they can just pay the 10% interest on this loan every year. They don't have to pay down the principal at any certain time. Tax rate for the firm in either form here is going to be 25%. So let's see what happens in a good year. So in a good year, for both the conservatives and the Cowboys, the sales are 50 million. Of course, that's going to be the same because the customers don't know, the sales don't know, don't care what the financing of the firm is. They just customers care about how great the products are. Operating expenses, right, nothing to do with paying interest, are going to be the same for each firm. They're going to need the same number of employees, same number of factories, et cetera, irrespective of how they finance the purchase of this firm. Okay, but now we start getting to some differences. You see here the conservatives, they have no deal with JP Morgan Chase. They don't have to pay JP Morgan Chase anything, any interest. So their earnings before tax is just 50 minus 30 or 20. They pay 25% in tax. That's 5 million. So they have net income of 15 million. For the Cowboys, after operating expenses, they still have to pay Jamie Dimon his 9 million in interest. So their earnings before tax is only 11 million. They pay their 25% tax on that, which is 2.75, and they get net income of only 8.25. So it looks like the conservatives did much better in this. But did they really? I don't know. They have here, if we use our debt to assets ratio, the conservatives have a debt to assets ratio of 0. The debt is 0, so the ratio is going to be 0. And the Cowboys have a debt to asset ratio of 90 over 100, which is in most circles 90%. But check out the ROE in both cases. Okay, the ROE for the conservatives is 15 over 100, not bad. But look at the ROE for the Cowboys, 8.25 over 10, or 82.5%. That's outrageously good. And this is why private equity firms do leveraged buyouts, right? You can get this extraordinary ROE. And what's another advantage of the Cowboy approach? The Cowboys also, what do they have? Cowboys also have 90 million left to do 9 more deals like this. Okay, and so that's pretty cool. Okay, so the Cowboys in general are going to be, it looks like right now, much better off. Looks like they're much smarter. They're going to be diversified. Always great to be diversified. You never want to put all your eggs into one basket. So that's a nice thing for the Cowboys. And they're enjoying potentially something like an 80% ROE on each of their deals. Okay, but the conservatives, you folks who chose to be conservatives, you're maybe not as dumb as I'm making you out to be. Let's consider now what happens in a bad year. Okay, so we've done a good year over here. Now we're going to do a bad year. So let's say sales drop from 50 to 30. Sales drop this much or much more even in 2008 for many firms. So this could happen in our lifetime. Operating expenses are going to go down, but not completely in proportional to sales. There are some fixed costs that you just can't bring down if you're going to keep operating your company. So operating expenses, 25 for both the conservatives and the Cowboys. And now the conservatives are done. No interest, so they still have earnings before tax of 5. They pay some interest. They have net income, positive net income of 3.75. The Cowboys, can the Cowboys go to Jamie Dimon and say, I'm sorry, we're having a bad year. Let's skip the interest we have to pay you for this year? I don't think so. Okay, so they've got to pay their $9 million to Jamie Dimon, so their earnings before tax is going to be minus $4 million. And this is well beyond the scope of this course, but in many circumstances, you can actually, if you have a negative earnings before tax year, you can actually get a cash credit from the IRS. So they might actually get $1 million back from the IRS during that year. But nonetheless, they still have negative income of $3 million. Okay. Debt to assets ratio, exactly the same, okay? And the ROE now for the conservatives is still positive, okay? But look what it is for the Cowboys here. The ROE for the Cowboys now minus 30%, okay? What's going to happen if they have 2 or 3 bad years? They're going to run out of cash on the balance sheet, and they're going to go out of business because their operations are bleeding cash by on the order of $3 million a year, and they're just going to run out of cash and go out of business. So that's not so great for the Cowboys. Couple more things to think about this while we're here is if you are in the Cowboy camp, what happens if you just have 2 good years, and then you have a really bad year, you don't have much cash on the balance sheet, you don't have many assets you can sell, and you have to go out of business, you have to turn over the keys to Jamie Dimon. Well, if you have 2 good years, you're going to have net income of $8.25 million times 2, $16.5 million. What did you put into the firm? Your equity, what did you put into the firm? You put in $10 million. Okay, so when Jamie Dimon comes for you for the keys to the firm because you can't pay your interest in the 3rd year, you're going to give him the keys to the firm with a smile on your face and love in your heart and walk away. And you're just going to let this company go bankrupt, walk away, and you're still going to come out way ahead. You're going to come out $6.5 million ahead on your $10 million investment after 2 years, which is another thing that private equity firms do. Okay, you can't do that. You can't do that too long because you keep doing that, and Jamie Dimon's not going to give you loans anymore, right? So you have to be careful about that. Okay, so with that in mind, let's do some more ratios here. Our debt to cap ratio is next up. This is my personal favorite. The first of all, we have to define what we mean by capitalization to look at our debt to cap ratio. And capitalization is defined to be a firm's total debt plus its equity, okay, as shown, of course, on the balance sheet. And what it is qualitatively is all the sources of cash that a company used to buy its long-term assets, okay? So our debt to capital ratio is going to be long-term and short-term debt in the numerator divided by total debt plus equity in the denominator, or debt divided by total capital or capitalization. Qualitatively, what this ratio is measuring is what percent of a firm's capitalization was provided by debt. And with all these ratios, bigger is going to mean bigger rewards in good times with more downside risk. And the way we talk about this is usually with percent. We say things like our debt to cap is 27%. Okay, once again, just like debt to assets, regulated utility has a big debt to cap ratio. A technology startup is going to have a smaller debt to cap ratio. So, important question. What about a debt to cap ratio that's greater than 100%? Could that be possible? Well, let's see. Oops. Let's go to our typewriter tool and rewrite this ratio. Okay, debt over debt plus equity is our ratio. So you need to ask the question, algebraically, can that ratio be bigger than 1? So just think of the algebra. So algebraically, could that ratio be greater than 1? Yes, absolutely, it could. And so that's going to lead us to yes, that ratio can be greater than 100%. So what does this mean? Clearly, to make that work algebraically, it means the firm has negative equity. And that's definitely something that is possible, right? And this does not mean bankruptcy. Bankruptcy happens when a firm runs out of cash. Which is a different thing, of course. Okay, so how could firm get negative equity? How does negative equity happen? Well, let's remember this. We have equity EOP is equal to equity BOP plus net income plus paid in capital minus dividends. Okay, so imagine a firm that has negative net income for a number of years and no paid-in capital and no dividends. What's going to happen to its equity every year? It's going to get smaller and smaller and smaller and smaller. Okay. And after a while, it could certainly algebraically go negative. And that does happen, and it doesn't necessarily mean that the firm in question is going to go bankrupt very soon. It usually means it's in danger of going bankrupt, but it doesn't mean for sure it's going to go bankrupt. Okay, next ratio up is our debt to EBIT ratio. Debt to EBIT is defined to be debt at our end of period divided by the EBIT in the period. EBIT, again, is earnings before interest and tax. Okay, and this ratio, we have balance sheet term and income statement term. So the units of this are going to be dollars per period. We always want to be considering dollars per year units. So if we have dollars per quarter, we're going to multiply by 4 to get dollars per year units. So the units of this are going to be years at the end of the day. So this is really going to be telling us how many years it would take to amortize our debt if all of our EBIT was dedicated to this, which is a nice thing to know. So we'd talk about this in years. We'd say something like our debt to EBIT is 4 years. Okay. This, of course, isn't exactly 100% perfect, doesn't include interest payments. It assumes that our EBIT would be constant until paid off, et cetera, but it's still extremely helpful to compare a company to its comps and industry averages to industry averages. Okay. All right, now let's shift gears a little and let's talk about operating leverage. Remember, operating leverage is measuring the ratio of fixed costs to variable costs. Okay. Fixed costs are costs that don't scale, as we've said before, with small and medium increases in sales. We're going to say in this class, just so we have a definition we can apply very easily and clearly, we're going to say fixed costs are costs that cannot be eliminated easily in a quarter. So I'm going to modify this a little bit here. I'm going to say eliminated easily in a quarter. Okay. And variable costs, as we've said before, are costs that scale linearly with small and medium increases in sales. And we're going to use, just so we have a clear definition we can always apply, costs that can be eliminated, and again, I'll put easily up there, in a quarter. All right. Operating leverage has a very similar effect on a firm to financial leverage. Higher operating leverage means higher returns for owners when sales are high, but more bankruptcy risk. And another important thing to think about a little is financial leverage and operating leverage are not completely independent. So interest, for example, is of course related to financial leverage, but it's also a fixed cost. So it will come into our fixed versus variable cost ratios. So now let's think about how and why operating leverage works. So to do that, let's consider West End advisors versus, for example, a carpenter. So let's say at the beginning of the year, each one has $100,000 in assets. Each one has 0 debt, so we're taking financial leverage out of the equation altogether, right? So this is no financial leverage. Okay, and our equity is 100,000 for each firm. Okay, West End is going to have no variable costs at all, okay? Um, and it has annual fixed costs of 20,000, okay? So West End doesn't have any costs that vary as a function of its revenue. It has analysts. It's got to pay for its space. It's got to pay rent on its space. It's got to pay for computers and data sources, and that's about it. The carpenter clearly has variable costs. She needs gasoline for her truck. She has materials she's got to buy for the things that she's building, the more jobs that she gets. She's also going to have some annual fixed costs, which are going to be things like the lease payments on her truck if she's leased her truck, or her actual truck payments if she bought the truck. Those are not going to be a function of what her revenue is. Okay, so let's see how things go in a good year. In a good year, let's say each firm has 50,000 in sales. West End is going to have no variable costs, okay, and the carpenter is going to have 10,000 in variable costs, and the fixed costs for West End going to be 20,000. We don't pay our analysts much, but whatever. And the carpenter has 10,000 in truck payments and things like that. So each of them has 30,000 in earnings before tax. They each pay the same tax rate. They each have the same net income, and the fixed cost to total costs for West End, 100%, 50% for the carpenter. ROE, same for both firms. Now let's think about a bad year. Let's say sales go down by 50%, which for a small company, very easy to have happen in a given year. Variable costs, again, West End has none, but it's still got the fixed costs. If it wants to stay in business, it can't abrogate its rent agreement. It can't fire its analysts. It's got to keep its computers. It's got to keep its data subscriptions, its annual data subscriptions. So it's going to have earnings before tax of only 5,000. Now the carpenter, her fixed costs aren't going to change in a bad year. She's still got 10,000 in fixed costs, but for her variable costs, so she has 25,000 less work. She's got less gas to buy. She's got less materials to buy, and so those variable costs scale with her sales. They go down by 50%. As the sales did. So they go down from 10,000 to 5,000. So her earnings before tax is better. It's 10,000 here. They each pay tax, net income of the carpenter twice as good in this case as West End. And now her fixed to total cost ratio has gone up to 66.7% from 50%. But her ROE is twice of what West End's is, which is pretty good. And this shows us the risk to a high operating leverage company in bad times. Now let's look at a very good year. Let's say that sales of each company increase to 75,000. Again, West End has no variable costs. So now the earnings before tax for West End is very nice, 55,000. The carpenter, her variable costs have gone up from 10,000 to 15,000. Her fixed costs remain the same. So she doesn't have as good an earnings before tax. We both pay our tax at 25%. She doesn't have as good a net income as West End, and she does not have as good an ROE. So this shows us that in good times, having a high fixed cost structure is better than having a high variable cost structure. But in a bad year, just the opposite. If you have a high variable cost structure, your sales come down, so do your costs, and that gives you a nice cushion in bad times. Okay. So how do we measure operating leverage? GAAP does not require, we've never seen on an income statement identification of fixed and variable costs in GAAP financial statements. In other words, we haven't seen an income statement organized like this with sales, variable costs, fixed costs. We only see that in a microeconomics course or if we were an insider of the firm. So that's a problem. So no one provides this information, fixed and variable costs, publicly because, of course, you don't want your competitors to know that information. So if we're outsiders, we're going to have to try to approximate this, okay? And there's pretty much only one really reasonable ratio to do that, and that's the SDI to COGS ratio, which is defined to be SGA plus depreciation plus interest over COGS. So which one here? This is a fixed cost to variable cost ratio, okay? And which is the fixed here? Here are our fixed costs. Okay, our interest, as we know, we can't go to Jamie Dimon and say our sales were bad this year, please reduce our required interest payment. But COGS is pretty much a good variable cost indicator. If our sales are going down, we're going to have less COGS because we're going to convert less inventory into sales. Okay. So bigger here is going to mean more operating leverage, and that, as usual, is better for owners in good times. Okay. And this is not perfect because SGA may include some variable costs, and COGS may even include some relatively fixed costs. None of these ratios are perfect. Okay, EBITDA we will come back to later, so I'm going to leave this grayed out for right now. And here's another fixed to variable cost ratio that doesn't work very well, so we're leaving that grayed out. So I think what we should start off with in the next segment is an example with Continental and Love looking at their leverage ratios. So we will do that in just a second.